India Mart shares plunged close to 7.5% on the back of weak third quarter earnings marked by a decline in quarterly paying subscribers. Nomura too downgrades its stock to reduce, slashing the target price to 1990 from over 3100 rupees.
ICICI Prudential plunges in early trade after insurer misses its VNB estimates despite strong operational growth. Morgan Stanley View trims VNB forecast for FY25 and FY27, while Macquarie sees downside risk to their FY25 VNB estimates.
Jana Small Finance Bank rallies on the back of steady numbers coming in, up 17% for the stock as the company reports strong loan growth in the third quarter. The management says worst is behind for the bank.
Cyient DLM declines over 11% after a mixed showing in the third quarter, while revenue growth came in reasonably strong on a consolidated basis. Margins and profitability were impacted by higher employee cost as well as a couple of one-off costs.
Oberoi Realty trades in the red after brokerage firm Nomura cuts target price on the stock to 2300, says the management believes the tower launch at Elysian could be delayed to FY26.
Hello and welcome to Chartbusters. I'm Nigel, with me is Mangalam, and as you can see, there's no worries on the headline index. The Nifty is doing quite well. The Nifty Bank well mildly in the green. The problem is in the broader markets. But Mangalam, as we've been saying as well, that in the near term, it could be a bit of a rocky ride. Though in the longer term, some of these opportunities, when you get some kind of skittishness in the market, they have proved to be good investing opportunities as well. So if you're in for the long term, well, in fact, it's presenting you an opportunity. In the near term, though, things are a little bit skittish, particularly with the broader markets.
I guess everyone will look at, when the FIIs return to the market when it comes to flows, etc. And at what point do earnings return as well is something that we'll most definitely keep an eye out on. Currently, the only thing more relentless than the way, bears are attacking is the way Novak Djokovic was playing versus Alcaraz yesterday.
Wow.
So we'll keep an eye out on that. The mid-cap index continues to be under pressure. But among all of that, one of the stocks which is on our radar is UCO Bank. They reported a strong performance in the third quarter, marked by a near 27% jump in net profit, led by 17% plus loan growth as well. Ashwini Kumar, who's the MD and CEO of UCO Bank, joins in to discuss the latest earning release and the outlook ahead. Thanks a lot, Mr. Kumar, for joining in. Remember speaking to you just a couple of weeks ago when you did speak about, the timeline for the QIP, and you did say that in the third quarter, when the numbers come by, you will be surprised because they are largely in the guided band itself of close to 12 to 14% loan growth, NIMs between 3.8 to 3.9% as well. But among all of those data points, what you've actually done is you've beat your loan growth estimate. Close to around 17% is what the loans have grown at. Even the NIMs, which have been above the guided band of 2.9 to 3% as well. So the question is on loan growth and NIMs, what is your target for this year? And if you can hazard a target, an aspiration for the next year as well.
Thank you for having me on the show. As you can see that our guidance for the loan growth was around 12 to 14%. We have already clocked in last 3 quarters above 14%. And in the fourth quarter also, we expect the same trend to continue. But within the overall guidance, we may exceed the loan growth guidance in the fourth quarter as well for the year whole as well. On NIM, we have given a guidance of 2.9 to 3, and then we revised to 3 to 3.10, and we have surpassed that guidance also, 3.17. This is done by containing the cost of funds and also improving yield on advances. You can see that our yield on advances and cost of funds is much contained over a period of time. Next year, we expect the loan growth to be around again 12 to 14%. That will be our internal target, and we'll try to surpass our targets or the guidance which we give. And NIM, because of the upcoming rate cut cycle anytime next year, next quarter or thereafter, we expect some impact on the NIMs. But our intent will continue to be maintaining the NIM in 3 to 3.10 in the next year also.
Sorry, can you repeat the NIM number once again? To 3 to 3.10 is what you're looking at, irrespective of what the rate cycle says, right?
Yeah, currently our NIM is 3.17. So there is a possibility of a rate cut also.
Right.
So our intention will be to maintain our NIM in the range of 3 to 3.10.
All right. Hi, sir. Good morning and good to see you. And yet again, give us some color on asset quality, which seems to have improved. Slippages are down. Gross NPAs have cooled off. Net NPAs as well have cooled off. So on these three numbers, what is the guidance going ahead?
See, we have been improving our gross NPA and net NPA on a quarter-on-quarter basis. Our guidance was less than 3. We have already achieved 2.91. And net NPA guidance was 0.65. We have already achieved 0.63. And our target will be to further reduce our gross NPA in this quarter and next year also. We intend to reach to 2.5 our gross NPA in the next year and less than 0.5 net NPA in the next year.
All right, so less than 0.5 net NPA in the next year with 2 to 2.5% gross NPA, 3 to 3.1% NIMs, and 12 to 14% loan growth. We've got all those details from you. Also on the CD ratio, your target was 75%. You've come closer to 72%. So what's your deposit mobilization strategy from here on?
If you look at our deposit growth in the last 2 quarters, last quarter our deposit growth was more than 10.5, around 10.5, and this quarter in December quarter is on 9.36. So the momentum has picked up in the deposit front from the last quarter, September and December. The momentum will continue. We have made our resources team at zonal level. They are doing the customer connect program has been launched. Our staff is reaching out to the customers for garnering fresh deposits and also for the quality customer acquisition. We have launched tab banking. We are reaching out to the customer for opening salary accounts. We have tied up with some of the institutes also for opening of salary accounts. So the focus on fixed deposit or the resources will continue in the next year, as we have already now reached almost 75% of CD ratio, which we were targeting it at the start of the year.
So what is your current CASA and what do you intend to take it to with this mobilization strategy?
See, current CASA guidance was 37 to 38%, and at the start of the year also we were at the same. We have not dipped in the CASA, and our intention will be that at least to maintain this CASA ratio, because currently, as you know, the CASA is getting people are moving from saver to investor, and a lot of money is moving to the mutual funds. As a result, CASA is getting converted to the bulk deposits. So our target will be that we should not dip below 37-38%. We should maintain our CASA ratio to 37 to 38%.
And final question before we let you go on QIP. When does that happen?
Anytime after these results. Now we'll be going for the road shows, and then we'll be launching QIP.
In this financial year or the next one?
Yes, this quarter.
Okay. Thank you so much for joining in and giving us all those details from a loan growth and business growth standpoint, but more importantly, in this quarter as well, there would be a QIP which may come by as well. That's UCO Bank. With that, we'll get you some ideas for profit coming in from our colleagues at Money Control Pro, and today we have Nitin Agarwal joining in.
Hello, the company that I have chosen for today is Cyient Limited, which is an auto ancillary company and manufactures tires for all the OEMs across segments such as PV, commercial vehicle and two-wheeler segment. First, let me touch upon its latest quarterly number. The company recorded a YY growth of around 11.6% in its top line, driven by the strong demand. However, what spooked the investor is the significant contraction in its EBITDA margin, primarily driven by its significant rise in the raw material basket. However, there are a couple of factors that make us upbeat about the company. First, the demand outlook across segments continues to be very, very robust. Talking about the commercial vehicle segment, which has been continuing its momentum primarily on the back of government's focus on construction, infrastructure, and mining activity. PV passenger vehicle will also continues to have a strong momentum. Further, the company has been foraying into the high-value, high-margin product of highway construction and the truck radial tires, which are expected to improve the realization and the EBITDA margin for the company. In addition to that, the company has been taking price hike to pass on the rise in the raw material prices, which are expected to trickle down to its operating margin in a quarter or 2 quarters. In terms of valuation, the company currently trades at around 19 times FY26 projected earnings, which we believe is very reasonable given the growth outlook and the stock correction that has happened in the stock price.
Let's slip into a short break now. On the other side, we have the management of Cyient DLM. Don't go anywhere. This exclusive conversation coming up for you. We have Anthony Montalbano who will join in.
Well, Cyient DLM, that's a stock that's taking a hard knock in today's trading session. The consolidated revenue looks good. However, the standalone revenue growth appears a little bit tepid, and profitability has been impacted by a couple of one-off costs. To understand what went on in the past quarter, what's the way ahead, we're joined by Mr. Anthony, the Chief Executive Officer of the company. Hi, Mr. Anthony. Good morning, and thanks a lot for joining in. Well, give us a few details. If I look at your growth, it looks good, but that's more because of the inorganic growth. I recall you have been maintaining that you will be growing by 30 to 40%. So could you tell us what is the reasoning for this weakish standalone revenue growth, point number one? And margins were impacted in the past quarter because of a couple of one-offs. What do the margins look like from quarter 4 onwards, because those one-offs will not be there?
Well, nice to be here. So regarding some of the organic business, that business is good portion of that does come from sectors including aero and defense, where some of those programs, especially newer programs, can shift in timing and also on award of those deals as well. So as we've indicated in the past, this can be a bit lumpy in those sectors, and but the outlook in those sectors has actually been quite strong. For A&D, that's where we have seen a good amount of our growth from our current client base. But there also has been in some of the other sectors, such as industrial and a little bit of medical, where we've had some softness there. And we have new programs coming up to try and mitigate that here in the coming quarters. Also, just regarding the profitability of it, obviously that's tied a big part of it due to client program mix. We are currently shipping a very large defense program that is a little bit lower. It is lower margin than the rest of our portfolio. We'll complete that program next quarter, and then our profitability and our profitability due to the client mix should improve after we complete that program.
So let's get this simplified. There were a couple of shifts, in some of the sectors that you work with, and there is an order, a large order, defense-related order that has impacted the margins that will end in the next quarter itself. So
that's correct.
This year, by the end of this year, where do you see your annual revenue growth? And for the next year, once the lumpiness is taken out, etc., what is the growth that you're targeting on your top line, and what is a normalized margin for you?
Yeah, so starting with the top line, we've tried to provide just some rough guidance, not specifically years, but just more of a CAGR over multiple years. We like to see it about a 30% growth. I think the year before we had over 43%. This year will come in less. Next year is still forming. So still over the midterm, that 30% year-on-year growth is where we like to be, which is in line with the sector as well. But again, that will vary quarter to quarter and even during parts of the year. Regarding the bottom line, we look to operate the business at about a 10% EBITDA, and that is a solid, really a solid baseline for the business that will, that can vary again quarter to quarter. But even as we go forward and as we have a higher concentration of business that is higher margin, we actually expect to see upside from that, and especially if we deliver the programs they have designed.
Okay, in the past you have been speaking about double-digit EBITDA margins by FY26. Is that on?
Yes, that is very much where we should be delivering. I think we'll definitely be there by FY26, if not even completing this fiscal year at that level.
Oh, all right. So maybe towards the end of this fiscal year as well, you'll get closer to around the double-digit mark. And in FY26, you're saying for the year, it'll definitely be in double-digit margins, right?
That's how we are trajectory in business at this time, yes.
A quick word on the order book. You had told us that the second half of the year is going to look very, very strong. The order book, well, it's holding at around that 2,150 crores odd. On a year-on-year basis, it's still a little bit lower. Could you tell us, you have won some orders, I think, post quarter 3 as well. So where do you expect to end the year with in terms of order book?
Yeah, so order book that is again dependent on a few key strategic deals that as we close those deals and as those orders come in, you will see the order book have the impact in that regard. And so and again during this year we have been delivering for most of the quarters record revenue, and that's had some impact as far as consuming the backlog that we have. But the order book will come in here as we secure some of these larger programs that we have targeted. We hope to be able to announce those in the coming quarters, and that will provide some positive momentum in that regard.
Just a couple of questions before we let you go on the order book itself. First, you said that you are looking to get in some order wins, etc. If you could give us a aspirational target of what are the kind of inflows that you're looking at in the fourth quarter and the next financial year. And the second part is on Altech. If you could give us a sense of how much of the business has scaled, what's the aspiration here, and what could the synergy benefits be?
Yeah, absolutely. I'll start with the Altech piece, as that has really positioned us quite well. Again, this is the first quarter that we've had them as part of the operations. There's already a good amount of synergy happening from a client perspective. Recent political momentum has also had that U.S. operation ability be very interesting to our clients, as that opens up many opportunities. So Altech has actually had similar bottom line and recently even top line performance to what we've delivered on. So we see it as quite complementary to the overall business, and we also see it as an area where our current clients will find a very similar DNA and type of operation in Western markets than what they're experiencing with us today in India.
Has Altech hit $50 million of revenues? When do you think?
So we don't break down the specific numbers for that, but the business has currently been at a run rate just a bit shy of that. But again, we do see a robust outlook for that business. Absolutely.
Ask you about that because it's done around 35-40 million in the past. So the street would like to see that scaling up, as you've been saying. Tremendous potential, but it needs to show in the numbers. Thanks a lot, Mr. Anthony, for joining in and filling us in with those details. You're sounding reasonably optimistic. For the time being, the street is disappointed with the past quarter's numbers, but 30% revenue growth with double-digit margins is what they'll be looking forward to in FY26. Well, stock is down close to around 13% or thereabouts. Let's slip into a short break, come back, continue to focus on markets and all the stock-specific action. Welcome back. After yesterday's sharp fall, at least the Nifty is up close to around 70 points. The problem is in the broader markets. You have close to around 3 stocks that are declining for every 1 stock that's advancing. And the Nifty Bank, that's as flat as can be. That said, we'll have to wrap up on this edition of Chartbusters. You stay with us. Trading Hour comes up next.